Thanks, Madam Chair. Mr. Cupper, testimony submitted by Better Markets refers to academic evidence suggesting that the aggregate level of speculation in the market adversely influences the behavior of prices, and that more speculation does not always mean more efficient prices. The Commodities Markets Oversight Coalition on the second panel today has submitted an attachment to their testimony referencing a number of articles that purport to show that speculation degrades market quality or that high-frequency trading causes harm to the market. Now, we all know that every market needs both speculators and hedgers in order to function properly. I understand from your testimony that MFA supports a data-driven approach to position limits. Now, have you reviewed the testimony of Better Markets and the Commodity Market Oversight Coalition? Are you familiar with the academic research? And could you just in general shed some light on this issue, please?
What I would say, thank you, Senator, is that there are numerous academic and government studies from the CFTC, GAO, OECD, plus international agencies, all consistently commenting on the role of speculators in the market. Those studies after study, have concluded consistently that first, they have not found excessive speculation to be the cause of market volatility in recent years, and secondly, they show that policies restricting investors' access to derivatives markets would impair the ability of commercial participants in the markets to manage their risk. We are in favor of a data-driven approach, a very careful assessment of what the facts are with respect to position limits or other restrictions on the ability of traders generally to access the markets.
Mr. Duffy, with respect to high-frequency trading, some of the panel have raised concerns about the role of high-frequency traders in the marketplace. Some have suggested that this trading activity is responsible for market disruptions, such as the many flash crashes in recent years or sudden price spikes. Can you give us your perspective on the role of high-frequency traders, and is this a term that has been actually defined by regulators?
Thank you, Senator. I think that high-frequency trading is getting a very clouded name at best right now. When it comes to many flash crashes or not, that basically does with market structure because of the fragmentation that we have in the securities world today, where you do not have the vertical silos of pools of liquidity in one central place. I think what's critically important for the American public to understand about high-frequency traders, trading is going fast. Technology is going to continue to make it go fast, and you're not going to put technology back in the bottle. So it's up to my exchanges like CME Group, groups like NFA and others to come up with ways to show the public how we're policing these participants. And that's exactly what we do. We spend over $40 million a year policing our marketplace, a lot of that dedicated towards high-frequency trading. We can say it all what we want, that these are good liquidity providers, but we have to show the American public that we are making certain that nobody is front-running an order or anything else that they're being accused of doing.
Mr. Duffy, I had significant conversations with Chairman Gensler leading up to the ultimate draft of and passage of Dodd-Frank relative to the way we're going to treat swaps and derivatives, which all of us knew some changes needed to be made, but I felt like that the direction we were heading in and the way where we wound up was pretty excessive, particularly with the regulations that we knew were going to be forthcoming from CFTC, and they haven't even been completed yet. We still don't know what they all are. And the issue that I kept raising with Chairman Gensler was that what's this going to do to American markets versus European markets and Asian markets? And the standard answer I got was, they will follow us. Well, I see where interesting enough, I was in Europe on a couple of occasions after those conversations, and I related that conversation to some of the folks in Europe, and they just got this wry smile on their face. And can you give us the benefit of where we are with respect to competitive advantages or disadvantages as a result of Dodd-Frank today?
Well, I hear what Chairman Gensler is saying, that they will follow us, but I'm still perplexed on seeing what laws that have been passed today in Europe or anything that's even been proposed or passed throughout Asia. There are things proposed in Europe but have not yet passed. So we have already gone with the passage of Dodd-Frank. I just returned from a European trip meeting with clients all throughout Europe, and when you make that reference to them, they are not just sitting around being beholden to the United States of America anymore. They are very sophisticated trading operations all throughout Europe, and they are they are garnering more and more market share each and every day, and this is something they feel quite excited about. So I think they're looking at it as an opportunity. We're all big believers in regulation, Senator, but I think we need less regulation with more teeth into it. We can't keep writing a bunch of rules that everybody can just circumvent. Let's have rules that have teeth in them, and I think that's what the American public would want, and I think it's hard for the European counterparts or Asian counterparts to refute that type of activity. But we're not doing that. We're writing rules on listed derivatives markets today, or listed futures markets that Congress didn't have anything to do with in Title VII. It was about over-the-counter swaps. So hopefully we can get back to what we're supposed to be doing here. But I will tell you that the folks, especially in Europe, are smiling quite nicely right now.
Thank you very